Good morning ma, welcome to Alpha Online Education. Commerce Theory part for the English medium first years. The chapter we are dealing with, that the joint stock company, and this is the last session of this chapter, that is the fifth session. By comparing the joint stock company with the partnership, we will going to complete this chapter today. So what is the difference between the partnership and joint stock company? Let us see by comparison. The Acts, Indian Partnership Act 1932, the Indian Partnership Act 1932. The partnership form has started with the regulation of Indian Partnership Act 1932, whereas come to joint stock company, that has been started with the Indian Companies Act 2013. Both are legal bodies and artificial bodies too. Okay. Next, registration. Registration of partnership form is not necessary, but if they register, they will enjoy certain privileges, means certain advantages they will enjoy, and also certain type of security is there. So registration is not compulsory, but if they want to enjoy certain advantages, they have to get registered. But here the registration is compulsory. There is no any kind of option of non-registration. Here the registration is compulsory. It means it is a mandatory. The company should have to be registered under Indian Company Act 2013. Next, commencement of the business. When this business can be start? So the partnership business can be start by the business after entering into an agreement. After entering into an agreement, a partnership business can be started. But whereas come to joint stock company, we have two types of company, private company and public company. So private company can start their business after getting certificate of incorporation from the registrar. Certificate of incorporation they have to get. Who? Private company. The private company should have to get the certificate of incorporation from the registrar. Whereas come to the public company, they have to get two certificates. What are those? Both certificates. Certificate of incorporation and commencement of business. Commencement of business means starting the business starting. Okay, that type of certificate also needed for the public company. Okay, right. Number of members. Here the minimum members in the partnership is 2. Okay, maximum members are 10 in case of banking. In case of banking, 10 are required, and 20 in case of non-banking. In case of non-banking, 20 members are required. In case of banking, 10, and in case of non-banking, 20 members are limited in partnership. Whereas come to here, again we have two types of companies, private company and public company. So in the private company, minimum 2 members are required, maximum 50 members are required. In public company, minimum 7 members are required, maximum unlimited members. Okay, there is no limit at all for the maximum, right? Next, legal status. It has no separate entity. So in the eyes of the law, partners and the firm, means partnership firm, both are same. Okay, but in the eyes of law, it has a separate entity. Owner is different and company is different according to the accounting concept. What is that? Business entity concept. What it says? Owner is different and business is different. Yes, according to that concept, it has a separate entity and it does not have any separate entity. Liability. In the partnership, the partners have unlimited liability. Their private property is used to claim the debts of the business, but in case of joint stock company, the liability of the members is very limited to the shares held by them. It is very limited up to the shares held by them, means the capital whatever they are contributed. Transfer of shares. Here the shares can't be transferred in the partnership form, because if a partner want to transfer the share, then he have to get permission from all the partners. He have to consult to all the partners if he want to transfer the share. Whereas here in case of joint stock company, there is no need to take any kind of permission with other parties. Okay, why? Because they can easily transfer the shares. That's why there is no need to ask for any other shareholder or any other board of director. They can easily transfer to the other person. Next, management. Management and control by the partners. The partners only control and manage the partnership firm. Whereas here the management is totally in the hands of board of directors. The board of directors will control the management. They will take the necessary decisions. They will participate in day-to-day activities of the business. Okay, everything is done by the board of directors here. But here everything is managed and controlled by partners. Next, existency. In the accounting concepts only, we have another concept, going concern concept. Okay, in that concept already you have studied, I think. What you have studied? The business will have a long life and it continue for a long period of time according to that concept. Same thing is here, existency. The existency of the partnership is uncertain, means it can be closed at any time. If a partner is die, or if a partner is retire, or if a partner is dissolving the partnership, at that time the total partnership will be closed. But in case of company, that will be not happened. If a partner die, even it will be continue. If a partner retire, even it will be continue. If a partner, new partner is new shareholder is entered, even though it is continued. If an employee is retired, even though it is continued. If an employee is die, at that time also it will be continued. So it is not affected by any kind of human damage to the company. Next, winding up. No legal formalities. If the partners are mutually agreed to wind up, they can easily wind up. Wind up means what, ma? Closing the company. Okay, if they are mutually agreed to close the company, so at that time there is no need to go for legal formalities, no need to go for court, or no need to go for the registrar, or no need to go for anywhere. So, but in case of joint stock company, during the time of winding up, they have to go to the court for the winding up of the company, means closing up of the company, or they have to go for the legal, and also they have to go for the legal formalities. Okay, they have to go for the legal formalities also. They have to go to the register, they have to cancel their company name, they have to do so many legal formalities. Okay, they have to settle the capital, whatever the capital brought by the shareholders. So much formalities are there that should be done in the joint stock company, and those things are absent in the partnership form. Let us see the 11th one, statutory regulations. No rules and regulations to maintain the books of accounts. In the partnership form, there is no any kind of rule. There is no any kind of regulation to prepare the books of accounts or to prepare the records of the accounts. So, there is no need. It is not a mandatory. If the partners want to do, they can do. If they are not interested, there is no need to prepare. But in the joint stock company, it is a mandatory. It is according to the Indian Company Act 2013. Every company should have to prepare their accounts. Along with the preparation of their accounts, they have to maintain the complete record of those accounts. Why they have to maintain that record? In order to get audit those accounts. Audit means checking the accounts. Some of the officers, chartered accountants, chartered accountants and the audit department employees will come and they will check the accounts of the companies. Position, partner in the firm act as an agent and the owner. So partner him itself act as a agent and also as a owner. But in the joint stock company, only the shareholder will act as the owner. Only the shareholder will act as the owner. Accounts need not audited by the auditor. So partnership firms no need to get audit their accounts, okay. But in case of joint stock company, they have to get their accounts audited with the auditor. They have to get their accounts audited with the auditor. It is a mandatory, it is necessary, it is in the law. As per the Indian Companies Act 2013, it is a completely mandatory to get their accounts audited with the auditor. It may be a chartered accountant. Next, creditors. The creditor of the firm are also considered as a creditor of the partners individually. Okay, the creditor. Creditor means who is the creditor? Creditor ante evarni creditor antam. So, who will give credit to the company, who will give credit to the firm, means who will give money to the company or money to the firm, and the company is have to pay for company have to pay for them. Those are known as the creditors, okay. For whom the company will have to pay. Company evariki baki untundo, evariki pay cheyalsindi untundo vallani creditors antam, okay. So, the creditors of the firm are also considered as the creditors of the partners individually. In case of partnership, if there is a creditor, he is not only creditor to the firm, he is a creditor to the partners also individually, because this combination of partners is only the firm. Yes, the combination of partners is only the firm. Here the creditor of the company or creditor of the company, but not the shareholder, because the shareholders are different and the creditors are the different. So there is no connection between the shareholder and the creditor. But in the partnership firm, there is a link between the creditor and the partners, because it is formed due to the formation of group of partners. So that's why there is a link. But whereas come to joint stock company, it is started with the aim of profit, and also it is registered under Indian Partnership Act. It has private company and public company. The limited number of members in case of private company we have discussed, that is 2, maximum 50, and public company, that is minimum 7 and maximum unlimited. So it is a separate legal entity, okay. So this question is very important question for 10 marks. Whether 10 marks or 5 marks, we don't know exactly, but this question is 100% they will ask, okay. Don't left this question, the difference between partnership. So in every chapter you have to keep in mind, again I am saying you that in every chapter you have to keep in mind if there is any difference, or if there is any classification, or if there is any types of partners or types of businesses, anything, and advantages, disadvantages, features, characteristics. So these things you should not have to left in any chapter. You have to read these things in every chapter, because these are the main things they will ask regularly, okay. The other things they will not ask that much, but these you have to focus more on this. If you have completed these, then when the time is left, then you can move for that. I think you have plenty of time now. This is the corona time, so you have plenty of time, so don't waste the time. You have to write the exam, so get mentally prepared. You have to write the exams in upcoming months, so get ready for that, okay. How you have passed 10th, that is over, that is the past is past, but your present is your intermediate first year. So do hard work, see all the videos, tell your friends to see the videos, and write down the notes. This all things what I have written, that is the short notes, means like a mind map. If you keep these type of things in your mind, it will be make you reading easy. So don't waste the time, do hard work as much as you can do, and also you have to stay at the home, okay. Right, all the best for your preparation, don't waste the time.